The trend-based Fibonacci time zone takes the concepts of Fibonacci extensions and applies them to the x-axis of time. That means most of the influence on the interval lines will be from the duration of the base trend. The main difference to other Fibonacci techniques is the default proportions only go up to 3, and only include the numbers ending with 0.382, 0.618, and whole numbers like 1, 2, and 3. There is the option to select 0.5, but this is almost never used. These Fibonacci proportions divide the duration of the base trend into sections that are close to 1/3 and 2/3 the length of the base trend's duration. Trends often do have 3 distinct phases. They start, pause, and continue, then end. These 3 phases can divide the trend into 3 main sections. They also don't necessarily happen at exactly 1/3 the increments and often get close to increments of 0.382 and 0.618, the duration of the base trend. Naturally, a short base trend is not usually useful since it produces interval lines that are too close together. Once interval 3 is passed, it is necessary to expand the intervals by expanding the base trend or by starting a new trend-based Fibonacci time zone. The base trend is normally a distinct trend with a clear reversal, and point 3 is normally placed at the start of the first retracement to the new trend. On this chart, the base trend is a clear uptrend that reversed, and point 3 is placed at the first upswing, forming the first retracement in the new downtrend. In the case of a continuation, point 3 is normally placed at the end of the retracement of the established trend. The trend-based Fibonacci time zone combines aspects of other time analysis methods in that it has equal increments of the base trend for the initial interval with the interval lines 1, 2, and 3. These equal increments can cover longer durations, while the intervals ending in 0.382 and 0.618 can capture smaller short-term features. The trend-based Fibonacci time zone can also have its interval lines applied even after there have been various trend reversals and retracements. However, the intervals are often most effective for the first trend the intervals are meant to cover. Intervals can also be used to identify the approximate time of continuations. In this case, for the uptrend that has a moderate reversal in 2016, which actually becomes a retracement in a larger uptrend. Stages of a chart pattern such as this ascending triangle will also usually be covered to some extent by the interval lines. After a major shift in a trend, it can be useful to start a new trend-based Fibonacci time zone. The final interval being 3 is not usually a problem, since time analysis normally begins to lose effectiveness after that, and there can normally be new base trends used for a new trend-based Fibonacci time zone. Switching to a shorter time frame like the daily chart also helps with smaller features and short-term developments, while longer time frames like weekly charts are useful for focusing on larger long-term features. Even when price is staying near record highs after a stock split, a trend-based Fibonacci time zone can be applied similar to how a Fibonacci extension can be applied. This method is often well suited for such situations when a chart moves to new record high or low ranges. This is because the established base trend often has a series of retracements from a clear swing point defining current record highs or record lows. Unlike a Fibonacci extension analyzing price, a trend-based Fibonacci time zone can use a pair of downswing or upswing points for points 2 and 3. It's also possible to choose a variety of swing points for point 3. Adjusting point 3 can be done to adjust the position of the entire set of interval lines. The greatest effect on the length of the intervals is from the base trend. In this case, trend lines can also help identify areas of potentially greater importance when they intersect with extension levels and interval lines. The main events of interest are bearish reversals and bullish continuations. Then, when 2021 begins with clear downtrend development, the main focus is on identifying the timeframes for support to succeed and produce upswings or fail and begin bearish continuations. The only exception is the return to resistance near 800 at interval 1, which focused attention back to the possibility of a bearish reversal taking place around April. As usual, too short of a base trend is not very useful even if point 3 is extended far to the right. Similar to a normal Fibonacci time zone, the trend-based Fibonacci time zone can be placed further back in the past to try and have interval levels intersect with significant events that have already formed on the chart. In this case, shortening the base trend and using an earlier clear retracement has the 1.382 interval run right through the middle of the current peak. This adds validity and points to the intervals after 1.382 being quite useful in the downtrend that follows. A minor adjustment of point 3 runs interval lines through many important features as well, but it is more applicable for the continuation context of the uptrend and less so for the reversal and continuation into the downtrend. This is because the interval lines up to the 1.382 line are mostly running through bullish features in the uptrend to validate the reliability of the trend-based Fibonacci time zone more for bullish context rather than the bearish context of the later downtrend. As usual, it is best to do price analysis before time analysis. The main feature here is support around the 70 price level and a likely drop down 3 retracement levels to the 0.5 level. Since the past few years had flatter price action and the current downtrend has frequent minor swing points, a short base trend is preferred. Point 3 is at the normal first position where the first retracement of the new trend begins. Since this is a progressing downtrend, the main events of interest are bearish continuations and bullish reversals, rather than bullish continuations and bearish reversals. Theoretically, there is greater support potential in November from the high concentration of intersections. This is true with bullish candles temporarily pausing the drop, but the bearish context is more than sufficient to break lower with increasing selling volume. Simple price action and volume show decreasing selling pressure and a declined triple bottom. These features coincide with interval 2 starting December with increased focus on a developing bullish reversal on the 0.618 retracement level. As the uptrend progresses, the events of interest are bearish reversals and bullish continuations. At interval 2.382 and the intersection of the trend lines in mid-December, consistent bearish volume is almost absent, as moderate bullish volume establishes a mostly neutral to slightly bullish stance to end 2016. This once again demonstrates the importance of observing price analysis in addition to the intervals. A similar situation takes place towards March to overcome the upper downtrend line intersection, which is an excellent substitute for the absence of interval lines after interval 3. Now there's the choice to try and expand the intervals to cover periods further into the future. Various swing points from the start of the downtrend in combination with the old base trend are poor choices not only because they don't extend intervals further to the right. The context is mostly effective for the downtrend and early stages of the uptrend until early 2017. The use of a shorter base trend and earlier retracement allowed for the targeting of interval lines with important stages in the downtrend. Most notable is the 0.382 interval and the peak downswing. This produced highly reliable short-term intervals to identify possible times for bearish continuations and bullish retracements for most of the downtrend. Since the newer uptrend into 2017 had less frequent and minor swing points, it was possible to use the longer base trend duration of the entire downtrend. The decline triple bottom presents possible points to place point 3 of the new trend-based Fibonacci time zone to cover the 2017 uptrend. Here's a case where moving point 3 is a viable option to move intervals further into the future without switching to a new base trend. It is still a valid and reliable choice since interval lines still run through many clear swing points and continuations. Similar to other examples, a pattern like an ascending triangle provides suitable conditions for the use of a Fibonacci extension and a trend-based Fibonacci time zone. This first choice of a base trend and retracement is quite valid and reliable since it covers many key features in the double top, double bottom, and ascending triangle. The drawback is it will only be useful for 2 more interval lines. Significant events of interest following the ascending triangle completion are still bullish continuations and bearish reversals, approaching the 1.618 extension level. Except now, new time analysis will have to be applied. Unlike a Fibonacci extension covering price on the y-axis, a trend-based Fibonacci time zone will be greatly affected when the slightly higher downswing and upswing points are chosen. The results are quite good even when a more bearish to neutral phase starts at the end of 2019. The uptrend lines help narrow the time range of the sharp drop reversing near the 2 interval. The 1.618 and 2 intervals near the 104 price range don't cover any significant events near the default extension levels chosen. However, this is normal as seen in other examples. Not all intervals will cover significant events, and they still did identify minor reversals where the optional 1.272 and 1.414 extension levels would be if they were selected. Once the August peak near 112 was clearly developed, it was possible to target an interval line through this landmark with a trend-based Fibonacci time zone based on older price action within and before the ascending triangle. A shorter base trend and the same retracement before the ascending triangle break was a poor choice because of the less frequent swing points after the ascending triangle, and the inability to capture any major swing points or continuations before or during the peak around 112. Naturally, the clear points from the low of the smaller double bottom within the ascending triangle to the peak at the 1.618 extension level, along with the first upswing in the downtrend, were clear features for more recent context. This allowed for valid and reliable coverage of the volatile neutral phase towards 2021. A Fibonacci extension and trend-based Fibonacci time zone are some of the best tools since this is a situation with limited price action after the IPO when price drops towards new record lows. While the main events of interest at the interval lines will be bearish continuations and bullish reversals, there can be some focus on bearish reversals. This is most apparent with the 1.618 interval after a minor bullish retracement. The downtrend lines mostly enhance the identification for events of interest concerning bearish reversals and bullish continuations. With an early uptrend under significant bearish conditions, the main focus is on support around the 0.786 extension level to hold and preferably produce an upswing by late March at the 1.382 interval. Bullish conditions emerge and progress from late March to May when a downswing is missed by interval lines. Again, this is normal, not all swing points can be covered. Towards early August, there is a similar situation back at the support range around the 21 price range. No bullish conditions emerge to reverse back up by the 2.618 interval, and the rapid drop quickly shifts attention for potential support at the next extension level around 18, but still around the time of the 2.618 interval. When approaching the trend line intersection with the 0.382 interval of a new, larger trend-based Fibonacci time zone, attention is directed at a bearish continuation or bullish break. When the bullish break started over the trend line before reaching the 0.382 interval, short-term attention switched to resistance being cleared near 22 by early March. Then, when an immediate downtrend filled in the gap, the main event turned out to be a bearish continuation right into March. After that, continued volatility had attention directed at whether new lows would establish under the trend line by the 0.618 interval. When a neutral to bullish stance began attention, then changed again to clearing resistance by the 0.618 interval. Since clear swing points were less frequent starting in late 2019, a shorter base trend was not very useful as it compressed intervals too close together to clearly identify distinct intersections of interest. When the chart is more range-bound with slightly more frequent swing points, a moderate base trend targeting an interval through the March 2020 lows produces a useful set of intervals. During more range-bound trading phases, attention is primarily focused on when the range could end, and not necessarily which direction the range will end with a breakout. During such rapid movements near an interval like the 2.618 interval, attention rapidly changes like in other examples. In this case, attention is first directed at clearing resistance under 25 before 2021. When this doesn't happen, attention is directed at a potential upswing around support at 22 by the start of the new year. Similar to other examples, a new base trend and retracement based on older price are chosen to target major landmarks. In this case, the target is to run an interval line through the double bottom from late 2020. The main interval line of note is the 1.382 interval at the second upswing of the double bottom. This, along with other intervals running through clear swing points and continuation breakouts, provides a valid and reliable set of intervals during the continuation of the larger uptrend. Time analysis is certainly a unique and less common approach in technical analysis. As seen in the examples, it can produce highly variable results and is best used in confluence with more reliable price analysis. Practice time analysis on past price action and see how different variations of time analysis techniques can affect results. Also practice the application of these methods on current live charts and observe the resulting performance to understand the effects of your choices in defining interval durations. Time analysis definitely needs a lot of experience to use effectively. For more on Fibonacci methods, as well as indicators, follow Ascencore. Thanks for watching and have a nice day.